Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. This episode is sponsored by Charles Schwab. Joining us on the desk at the Nasdaq market site, we have Joyce, managing director on Nasdaq's market intelligence desk, as well as Erik Hirsch, co-CEO of Nasdaq-listed Hamilton Lane. We're here to discuss how investor bases could evolve in the long term as access to private markets is increasingly democratized. It is great to have both of you with us. Welcome to Trade Talks. It's interesting, Erik, because such a big chunk of investor assets are still concentrated in the public markets.
For the retail investor, they're almost all in the public markets. If you look at sort of average allocation across the normal investor, it's basically 0% of things that are not public, aside from the house that they might own. And so this is really just the beginning of what's going to be a very, very long journey.
Yeah, and Brian, if we actually take a look at a 30-year chart at a number of different indices, the public investor, the retail investor, has had a pretty good run in the public markets for sure, despite shutdowns, 9/11, the GFC, COVID. Staying invested has certainly benefited them.
Certainly, you want to have your portfolio that's long-term, and you can certainly be shorter-term in nature with certain areas of your portfolio. But you know, whether it's a dot-com bubble, the housing bubble, COVID, you know, the fiscal dominance, especially, you know, to get us through some of these periods of time, has, you know, certainly been a boost to financial assets. And you can see the Nasdaq 100, the S&P 500, even small caps, you know, over the long term, certainly, you know, have been strong performers.
Yeah, and if we think about the 401k executive order, the recent one that just was enacted, leveraging access to the private markets, what are some of the operational challenges that you see as it relates to plan sponsors and executing on this?
Well, I think there's a lot of challenges. So if we sort of zoom back, I think the macro is sort of rightly oriented, which is we're really doing a disservice to the average American who is not in a pension fund, who is self-directing their retirement, who is by and large using a 401k program, and they've been shut out of the private markets. So their neighbor across the street, who might be a teacher or a fireman or a cop who's got a pension, they've been benefiting greatly from having access and exposure to the private markets. So I think at a very macro level, trying to kind of equalize that access and making sure that all savers in this country have access to it, as they do, frankly, in most other countries. Australia would be a great example, someone who does this very well. I think all that's sort of correctly oriented. Now, getting from sort of that concept to actually having the drop-down choice in your 401k menu, that's going to take some work. So there are some operational issues, there are a variety of legal issues that need to be dealt with around that. And so I think this is going to take some time, and it's going to take more than sort of an executive order saying, let's make this happen. It's going to need to have some more specific rule and regulation changes in order to drive that forward.
Yeah, because you certainly don't want to have regulation by enforcement either if you don't understand what those guardrails are.
Right, you don't want that. And you also don't want to create an environment where all of these new private market entrants into the 401k market are simply now a target for class action lawsuits constantly because the rules of engagement aren't kind of clearly enough understood, or what valuation policies are going to be, or how liquidity mechanisms work. So all of that needs to be ironed out in order for that move to actually happen.
Yeah, and Brian, we're seeing it in terms of demand, even if you want to use that IPO market as a proxy, with crypto or crypto adjacent recent IPOs as an example, where that alternative investment demand, we're getting into these investments early. Certainly, we've seen it in the volumes and the way these stocks have opened.
Yeah, the crypto space, especially, we're just, you know, seeing different types of companies, you know, coming to market, you know, based on the innovations, things like crypto, Bitcoin, you know, Galaxy is another switch that we recently had to Nasdaq, and so the demand there is certainly very strong, and we're seeing some of our top performing companies in the secondary market after IPOing in these alternative spaces that we're.
And it lends to wanting to get into these companies earlier or get into the private market space. I mean,
Certainly.
You could certainly see it once they hit the public markets for sure.
Absolutely.
Yeah. So let's talk about Evergreen instructions for a moment here. Explain what they are. How are they gaining traction? How could this help in terms of investors and access to liquidity and so forth?
So our industry's been around for 50 years, and basically the vehicle structure that we've all utilized are classic drawdown funds. An investor makes a commitment, that capital gets called as investments are made over a 5-year period, dollars are distributed back as things exit. So that's a great model for institutional investors who have the operational wherewithal and resources to be funding capital calls, dealing with distributions, and managing that. For most typical people, they don't want to deal with capital calls and drawdowns and all of that operational nonsense. We have day jobs and a life to live. And so evergreen structures are really just that. They are fully invested, evergreen in nature. So you fund, you make your commitment, it's fully funded on day one, and you're off to the races. And then the idea is you just leave it go. As things are exited, that capital will be reinvested. And so you as the investor don't need to constantly make reinvestment decisions. So much more friendly structure, and it has the benefit because it's taking in monthly subscriptions. It also has the ability for investors to have monthly liquidity or redemption provisions. And so for an asset class that prides itself on being very long-term, I think we've also recognized that saying to investors, hey, you just have to be tied up for decades, that's not pragmatic either. And so giving them a choice to have some liquidity, this structure I think has really caught on fire. We're raising a lot of capital, others are doing the same. It's much more investor friendly for all the reasons that we've talked about, and I think this is becoming the tool that people are using to access the market.
Well, let's talk about the deal landscape on a broader level here. I mean, the EA deal, right, valued at $55 billion. It was making headlines as the largest in the space. It had a consortium to execute on this deal. How do you think about this transaction in context of the broader private market space?
Well, Jill, I think you just said it. Context is essential. This is the largest leverage buyout ever.
Yeah.
$55 billion. We're in a world today where you've got NVIDIA with a market cap of $4.5 trillion. And so I think what my takeaway is the private markets are still small. The bulk and the vast majority of the capital is going into very small businesses. EA is the exception at $55 billion, big company, successful company. But even that took a large consortium to put together in order to finance that and actually do that deal. A couple of private equity firms, a sovereign wealth fund. So our asset class, for all of sort of the hype and the talk of it's growing and is it too big and is there too much money, I think when you step back and put it in context, the industry remains tiny in nature, and there are a huge number of private companies out there, and there's a lot of opportunity and there's a lot of room to continue to grow and scale. And there's also the reality that not every company wants to be public, and not every company is built to be public. And so you see that where companies like this, they believe they can be very successful as a private company. Maybe they return to the public markets later, but they now have the choice.
Yeah, and we've seen that quite frequently. It feels as if it's more frequent where companies are public for a number of years and then go back to private, then back to public and private again. So the deal environment is evolving.
Well, it's certainly not easy for many companies to be public. It's expensive. There's a lot of regulatory burdens placed on them. We've just seen talk that the administration is now looking to fast line, quarterly reporting, maybe to only semi-annual. So there's a lot of industry feedback that we're awaiting about that. Nasdaq, I think, is for it, but I think at the same time we want companies to have that choice and not be mandated one way or the other. So we'll see how that plays out. But we certainly are trying to advocate for our public companies on a number of different fronts, like short selling and other areas where it just makes life easier for companies to be public.
Right, right. Well, it's interesting because if you are reporting on a 6-month basis versus a quarterly basis, it has somewhat of a private feel to it in terms of not getting the numbers as frequently.
That's true. There would be less transparency.
Right.
You could argue in some cases. There are other areas in the world, like in the UK and in Europe, who over 10 years ago have gone to the 6-month model. So it may still work.
It's interesting because Hamilton Lane, a public company, a Nasdaq-listed company.
We're ironic.
It is ironic. So, well, give us the rationale behind it.
Well, I actually love strategically that we sit with sort of our feet planted in both worlds. So we've been a public company for over 7 years, and then obviously we're one of the leading private markets businesses in the world. And so the rationale for us being public was a few things. One, great brand enhancer. For a business like ours who's trying to grow and have a brand that's more of a household name, that's what we're sort of aspiring to, and to have that on a global basis, being a Nasdaq-listed publicly traded company gave us a market heft that we simply didn't have as a smaller private business. So that was reason number one. Reason number two is, like the private equity industry, we believe in equity ownership. And so we had a lot of equity ownership across our employee base, and giving them a way to align with the business and to ultimately monetize that when they felt appropriate, we thought was also an important feature. And so we've been able to do both. We don't regret it. It's been a great decision for us. Nasdaq's been a good partnership for us, and I think we've really gotten sort of both of the strategic things that we were looking for out of this.
And as you think about the frontier going forward, clearly technology and product design are going to help to accelerate some of these trends.
I think there's a huge push on that. So if we think about the world that we're sort of all moving towards, which is, again, dealing with sort of the retail investor is demanding. We are the retail investor. We want it now, we wanted it yesterday, we want it fast, we want it cheaper, we want it on our phone, we want it wherever we want it. And so we as an industry, if you're going to cater to that customer, we're going to have to meet that customer where that customer is. And that is a very technologically oriented customer. And so delivering them information, the ability to make decisions, and doing that in a way that's very technologically forward, I think is going to be crucial to success here.
When you look at the opportunities, let's call it over the next 12 to 24 months, from a regional perspective or sector perspective, where do you see the more, pound for your buck there?
Yeah, well, I think in a world that we're in right now, which is a lot of uncertainty, that I don't think you're looking so much for big themes. I think you're looking for pockets of things that get created because of a certain event. And so right now I think we're in much more of an episodic world because of what's going on. Government shutdown looming, tariff pieces changing, a lot of geopolitical instability around the globe. All of that creates unique event-specific opportunity, and I think that's what we're seeing, frankly, to be much more actionable today.
Yeah, I mean, we're seeing that in the pipeline as well, a broadening out of different types of sectors as well.
Yeah, we certainly have had a great year for IPOs, and so capital markets activity has been great. A lot of debt underwriting, a lot of M&A. IPOs are improving, best year for IPOs in 3 years. The SPAC market is coming back as well. And as you noted earlier, we are seeing it's not just say healthcare or technology companies that are coming to market to IPO. We're seeing IPOs across all sectors.
Yeah,
I think investors want more choice.
Yeah.
I think we've been in a world where the number of public companies really hasn't been increasing meaningfully, if in fact it's been long-term decreasing. And we sort of see the concentration in the stock market that's sort of at record levels. I think people just want more options, whether they're more options for public companies or more options in the private space. I think people just want more choice.
And you have that noted here where you're seeing infrastructure, energy transition, tech as it relates to that is really is attractive, and it makes sense, right? Energy transition, we need innovation leadership, it's national security.
People are reading about these things,
Yeah.
They want to invest in it. So they're reading about all of NVIDIA's success in their space, and then they're saying, well, someone's going to have to build the power plants to sort of do that, and someone's going to have to get the grid set up. A lot of that's going to get done on the private side.
Yes.
And so if you want to play that or be a part of that, sure, NVIDIA stock is a thing, but there's a lot of other things that are much smaller, and to your point, as you said earlier, people wanting to get in more on the ground level and not wait for that sort of company to be already so big and so successful. Well, in order to do that, that's the private market side.
Yeah, which is why I think the energy transition infrastructure plays are interesting. And
right in our wheelhouse.
At the ground floor there. So when you look ahead 5 to 10 years, let's call it, which is long term in today's day and age, how do you expect the investor base in private markets, whether it's retail, global, institution, how are you preparing for it structurally, and how do you see it evolving more generally?
I think you're going to see the individual investor have a portfolio that looks, frankly, a lot more like what the institutional investor looks like today. So if we take a classic institutional investor, they're running today about 20% in the privates, and then 80% in public, so across fixed income and equities and everything else. And so, but we contrast that to, again, the typical individual investor is basically 100-0 in terms of public-private. So I think the migration over the next 5 to 10 years is going to see their portfolio changing as people understand that if they're saving for retirement, that full liquidity should not be their number one focus. Long-term performance should be their number one that's their big goal. And so I think you're going to see these portfolios shift. There's going to be more product available to them. The technology is going to need to evolve to meet them where they are. And you're going to see big changes in their portfolio construction with a lot of that going into the privates.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.